Hello traders, today is Monday the 10th of January. My name is Double Hornsey, market as YouTrading, and today I'll be taking a look at the week ahead. Okay, before we take a quick look at the calendar, we'll take a look at the YouTrading.com Forex heat map. We can see the bottom left-hand corner is green, top right-hand corner is red, the euro is the weakest, and the Canadian dollar is like one of the strongest, along with the Aussie dollar. So for me today is start a London session, and it looks a bit a risk on, whereas at the end of last week it was looking risk off. So more of a positive note for the commodities and also the equity indexes probably. Obviously, big week ahead. There is a few tier one scheduled data points here that we can talk about on this calendar. The first being US led, it's the Fed chair, and he's testifying. Normally, if there was like a couple of days of testimony, the first day would be the sort of most market moving, as the second day is just a reiteration. However, it's just one day this week, Tuesday at 3 p.m. So I'd imagine a lot of trading that is done today will sort of calm down if there is any moves before this 3 p.m. Fed Chair Powell testimony. Then the market will definitely be focusing heavily on the US inflation data, the CPI here. So if we look at that, we've got CPI and then core CPI. It's obviously one measure of inflation, the core being it takes out the volatile energy and food. But the Fed prefer the personal consumption expenditure, so the PCE, but the markets pays a lot of attention to the CPI data. Again, on Thursday, we get some more price PPI, month over month data for the US. And then Friday, we've got the retail sales. So all important stuff. It all goes into the sort of mix for the Fed, who at the end of this month, FOMC are likely to announce that they're going to be doing rate hikes. They're definitely going to be talking about tapering quicker so they can get to these rate hikes. And everything that's sort of said, if we just go to the full calendar. So we've got lots of FOMC members speaking, got George Mester on Tuesday, and throughout the week, there's plenty more. As these guys speak, the Fed will be sort of giving the market some forward guidance on how fast they're going to taper, how much of a likelihood there might be 4 rate hikes this year. That's kind of the way the market's pivoting towards. We've also got to consider what happened basically last week. So we had, last week we had the NFP data, which was obviously a bit disappointing. It's supposed to come in at 400K, but actually this figure came at 199. The previous month had been revised higher, so that's a positive for the markets, and it's probably going to be revised higher again for December. And if we look down here, the average is 331,000 for this fiscal year. If we look to the left, pre the pandemic year of 1920, a good average was around 200,000. That was seen as good. So we're at pre-pandemic levels of employment for the NFP. So all in all, that's pretty good. If we just look up here, we've got fiscal flows. So this is the money that comes out of the US government into the non-government, so into the economy, into the savings and into the infrastructure and things like that. And if we look to the left for December, this fiscal year, December came in at 580 billion. And that's obviously the biggest amount of money since I started recording this data. So, the economy itself is doing pretty well. The jobs data wasn't that bad. It was just a bit of a disappointment compared to what both the market was expecting, but also what Fed Chair Powell would like to see. He would like to see 500 to 600,000 jobs each month coming in to try and get that unemployment back to full employment, because that's part of their dual mandate, and also to sort of get the participation rate rising as well, because at the moment that's lagging, and they can't really raise rates with any certainty until they've got full employment, because that's part of the mandate as well. So going back through this calendar, today is a bit of a quiet day, though, like we said, the euro is weaker. We've got the unemployment rate coming at 7.2, just under the previous month, and also as expected. Confidence index from Centix, that was slightly higher, so that's good. And the unemployment rate from Italy, slightly lower. So euro might get a little bit of a pickup, but with the Fed being like the sort of key data points this month. The rising yields, the US yields, are pushing the dollar a little bit higher. So that's going to affect the euro. So Tuesday, going through Aussie trade balance, that'll be interesting to see how they're doing. China's obviously one of their largest trading partners, and obviously if the Aussie are doing well, then that means China's doing good, and that as they're the second largest economy in the world, that means the world is doing good. Wednesday, going through, got Chinese CPI, PPI data for year over year. Expectations are for it to actually come in weaker. So if there is a positive spin to that, that would be a good thing. Euro industrial production, obviously, sort of based on what Germany's doing, slightly weaker expectations. So if we do get a positive number again, that would be good. For traders in the US equities, I'm noticing that the 10-year bond auctions and the 30-year bond auctions that we have on Wednesday and Thursday this week, they do affect the pace of trading on those days, especially in the NASDAQ. So I'm going to wait until after 6 p.m. on Wednesday and after 6 p.m. again on Thursday before making a trade in the US equities because of these bond auctions. So that's something else to look forward to. We do have MPC member Man speaking, so we'll look at the British pound because that's doing quite well at the moment after the Bank of England raised their rates 15 basis points. And on Friday, like I said, we've got core retail sales from the US as the main focus, but for the Euro USD traders, ECB President Lagarde is speaking, and that comes after some French CPI, European trade balance. So quite a busy week ahead. A lot of it will be frustrating. I don't think there's going to be a lot of trending moves at the moment. Everyone's kind of waiting to get all the data, and especially with sort of central bank members talking, that sort of seems to keep the market reverting to the mean quite a lot of the time. All right, let's just take a quick look through the active trader platform. So if we just go to the top here, we've got basically the Dow Jones, 30 companies, blue chip companies in the US. After the US data for the NFP came out worse than expected, we did have a bit of a drop, but the Dow itself has kind of held above its 20 and 50 and 200 period moving averages. So all doing well there. The US dollar versus the Japanese yen has come back down to the resistance, a level of 115.50, and is acting as support. I'm still fully expecting the dollar versus the yen to go higher, especially if these yields keep going higher. In terms of yields, if we go to the 30-year long bond ETF, the TLT here, we can see that the TLT is, like I say, a long bond. So as this goes down, that means the long yields are going higher, and that's following on the back of raising sort of short-term notes and bills yields going higher. So the sort of 3-month, the 2-year, the sort of 7-year, they're all going higher. The benchmark would be the 10-year. So if 10-year goes higher, then we'll see how well the US tech stocks and things like that can handle that. Gold, obviously seen as an inflation hedge of some sort. If expectations of inflation are going to be rising, then gold generally gets bought to try and sort of keep some of that wealth. At the moment, gold's going sideways. It's kind of pivoting around the magnet of $1,800 per ounce. So not a lot to say there, but the good news is it's not dropping. It's kind of just holding around the $1,800. We go to the British pound versus US dollar, which go back to a candle chart. I've marked up a descending trend line across the peaks here, kind of butting up against that. We've also got the daily 200 period moving average. So we're seeing that act as sort of confluence, some sort of dynamic resistance. This is all coming on the back of the Bank of England raising rates back down here. So as you can see, higher rates generally leads to a higher currency pair. And so we're seeing the pound versus US dollar rising. So that might happen until we get more aggressive FOMC and Fed funds rate hikes. Going to the euro versus US dollar, like I said, the euro today is weaker. it's in this sort of bear sort of wedge pennant. We had this big drop down from 28th of October 2021, obviously paused end of November, so a month later, so a month of drop, and then we've had over a month now of sideways. So big drop, big sideways, could be another big drop. Just quickly look at Aussie versus the yen, because that is your kind of risk on, risk off indicator. At the moment, you can see that the Aussie versus the yen holding above its 20-day period moving average. It's making higher swing highs, higher swing lows. So as long as we don't take out this swing low and go back below the sort of 50-day period moving average, we should sort of see this risk on sentiment increase and Aussie versus the yen go higher. If we just take a quick look at TradingView, this is a percentage of the S&P 500 stocks that are above their 200-day moving average. You see here, during the coronavirus, obviously, they started at around 80% of the 500 companies were above their 200-period moving average. That quickly declined all the way down to just a couple of percent as the world got locked down. We're nowhere near those sort of levels, and we're not even near the 50%. So at the moment, we're sort of seeing that companies in the S&P are doing quite well. So again, if we add it all up together, all those sort of data points, the stock market isn't doing too badly. We're kind of waiting to see how the Fed rate hikes, if they emerge as the market expects, how that sort of happens, in what sort of pace, and whether or not that's a market shock event. And yeah, we see the S&P and NASDAQ and such like collapse. But at the moment, until we actually get some firm moves from the Fed, it's all anticipation. So yeah, at the moment, market seems quite stable, just maybe a bit frustrating for trend followers. Just try and pick maybe a short to medium term trend. And for everybody else, it's kind of trading the ranges and mean reverting. All right, I hope that helps, and I'll speak to you again next week.